Hi, I'm Steve, and welcome to Bytes by Standard Chartered's Global Chief Investment Office. Adapting to an environment of higher interest rates. The relentless rise in bond yields has been the main theme in markets over 2022 and 2023. Since the beginning of 2021, the nominal US 10-year government bond yield has risen from 1.5% to a peak just above 5% in October. The real yield, which is calculated by subtracting inflation expectations from nominal yields, has risen from -1.02% to around 2.5%. While these may seem like abstract figures, they hold significant real-world implications. There are three implications that investors need to consider in a world of rising bond yields and high interest rates. First, rethinking capital allocation for companies. As the cost of capital escalates, companies need to reconsider their capital allocation strategies. The cost of marginal debt for firms has seen a significant uptick, with the average US investment grade and sub-investment grade, or high-yield, companies now funding themselves at around 6% and 9% interest rates, respectively. This stands in stark contrast to just 3 years ago, when the figures stood at around 2% and 4%. The cost of equity for firms has also risen, even though it is not directly visible. Both the cost of equity and cost of debt play a pivotal role in determining a company's overall cost of capital, the benchmark companies use to determine whether a capital project is worth pursuing. With a higher hurdle rate, fewer projects will look attractive, and companies may become more discerning when choosing which projects to invest in. This could inevitably lead to a slowdown in earnings and a shift away from high-risk, high-reward ventures in favor of more stable and predictable investments. Second, investors to become more selective. Higher bond yields compel investors to take a more selective stance. The US 10-year government bonds now offers above 4% nominal yield and close to 2.5% real yield, making them enticing investments for many. As a result, investors will need to consider how much risk they want to take in their portfolio going forward. Third, where yields go from here matters. While long-term real yields are currently sitting at the upper end of their historical ranges, uncertainty around whether they will continue to rise or potentially decline looms large. External factors can also sway the course of bond yields. In the second half of 2023, investors have increasingly demanded higher yields to hold US government bonds after the US Treasury surprised the market with new budget deficit estimates and ramped up bond issuances. Uncertainty over the demand or supply dynamics for US government bonds suggests bond yields may not fall significantly in the near term. However, over the next 6 to 12 months, long-dated bonds could prove attractive in an environment characterized by decelerating inflation, slowing economic growth, and a greater likelihood of the Fed opting for rate cuts. Thanks for watching. See you in the next episode.